Welcome back, everyone. Today on the Joseph Carlson Show, we know the market's getting a little bullish. We're seeing it in all the evidence. We can see it in the pricing of stocks alone. The forward price to earnings ratio of the S&P 500 and the QQQ are near historic highs. Big commentators like Tom Lee are on CNBC talking about how the market's going to go higher every single day. The bears in this market are long gone. They've been fired, they've been let go of their jobs, their predictions have been wrong, and nobody's listening to the bears. Even Michael Burry, the biggest bear of them all, is finally back to shorting stocks. Some of the top stocks in the market, some of the ones with the most exuberance, like Palantir, of which the CEO of Palantir, a stock that's worth 100 times price to sales, responded to Michael Burry saying that it's batshit crazy.
Super weird. Like the idea that chips and ontology is what you want to short is bat crazy.
And so far, he's been correct. Shorting anything in this market has been a mistake because this is a bull market. But as investors, if we're managing any amount of our wealth and our savings that we've worked hard for, we should be good stewards of it. We should be careful with the gains that we've made and the investments that we're making. We shouldn't follow in to the crowd with exuberance, beating up stock prices higher and higher. We should be looking for the best deals in the market, the ones that have ample downside protection, the ones where we're not going to get burned buying these companies. But the question is, which ones do we buy? There are thousands of companies in the market, so many that it's difficult to choose from. But in this episode, I'll be going over 6 investment ideas, 6 companies that I believe are still fantastic buys in an expensive market. Now, of course, like always, we have a lot of other news we'll be getting into this episode as well. We have the Uber CEO going onto CNBC explaining what happened this week with their earnings report, and he lays out an investment thesis for the future of Uber. We also have news that Amazon has sued Perplexity to stop them from using their AI tool to buy stuff. Perplexity responded by saying that Amazon is a bully, and bullying is not innovation. Is it true that Amazon is just a big bad bully pushing around the smaller company Perplexity where their only crime is simply trying to innovate? Well, of course, there's a lot more to the story we'll be going over. So we have all of this to get into, plus much more. Before we jump in, just a quick note. If you want to upgrade your investment analysis and have a better understanding of companies, Qualtrim is a platform that will turn you into a super investor. It is the best stock analysis platform. I know that because I've built Qualtrim from the ground up. It is tailor-made for value investors that want to focus on a company's fundamental developments over the next 5 years. One exciting development that we've recently done is we made it so you can sign up directly on Qualtrim.com. You can choose between a monthly plan with a 7-day free trial and an annual plan at a heavily discounted rate. Both of these are dirt cheap at under $10 per month. We have 11,000 active users on Qualtrim, and they love the platform for a reason. It's super cheap, easy to use, and it upgrades you as an investor. You can try it out now directly at Qualtrim.com, where you'll gain access to Qualtrim, as well as the Joseph Carlson Show Discord, where we discuss investing amongst thousands of investors. You can join the conversation there at no additional charge. Now, we start things off today by looking at 6 of the companies that I believe have the best stories in the market over the next 5 years. The first one is Meta. Meta just recently reported earnings along with a lot of other companies, but instead of the stock price skyrocketing up like Google, Meta's stock price fell. Google's stock is up 50% year to date and over 13% in just the past month. Meta's stock is only up 6% year to date, dragging behind both the S&P 500 and the QQQ. In the past month, it's down 11%. Now, anytime a high quality company goes through a sell-off, it's worth looking at. And part of the reason why Meta's underperforming and selling off may be temporary. Meta's underperformance is due to a couple different factors, but it's reminiscent of what happened in 2022 when Mark Zuckerberg was obsessed with talking about the metaverse. The problem then, similar to the problem now, is expected spending on capital expenditures. Meta is simply spending a fortune on Capex. Zuckerberg said that Meta would spend as much as $72 billion this year and, quote, notably larger in 2026. Then on the earnings call, he continued to downplay the concerns that Meta might be overspending on things like these superintelligence labs, saying, quote, it's the right strategy to aggressively front-load building capacity. Portfolio managers and investors are saying, quote, this feels like a return to Meta's old days of overspending on things that are frivolous or which don't have appropriate return demand tied to them. This seems like history's rhyming, if not repeating. We have a very similar situation. Meta's selling off big time, underperforming the market because the leadership is set on spending a lot of money on future Capex investments that investors aren't completely sold on. Well, we can look back in 2022 and see how that ended up. From 2022, Meta was below $200 per share. It even got as low as $100 per share. Now it's currently around $550 to $600 per share. It's had incredible outperformance over this time period. Now, again, the situation isn't identical. There were other concerns with Meta in 2022, and the forward PE ratio is much lower during that time period. But again, even though they're not identical, there's a lot of similarities. The metaverse spending concerns caused the stock to drop more than Meta has literally ever dropped before. The biggest drop in a 4-day period throughout its entire history. Then we see another massive drop for a similar reason. And I believe that there's less reason for investors to be concerned now than there was in 2022. For example, the reason that investors were concerned about spend in 2022 was because it was for the metaverse, for the headsets, for these niche products that billions of people did not use. So investors had reason to be concerned. They thought that the CEO was not really attaching their future spending to something that had high return potential. If we look at the sell-off today, the reason that the stock is going down is because of AI spending concerns. Now Meta's spending a lot more money, but they're spending on something that is a lot more relevant of a product to a lot more people. Spending in data capacity and AI is something that has far bigger applications and can benefit the company in far more diverse ways than just metaverse spending. Another thing that I think about with this sell-off in Meta is that, frankly, Mark Zuckerberg is correct. It is the right strategy to just aggressively front-load building capacity. That's been proven time and time again. If you don't front-load the building of capacity, then the demand comes, you cannot fulfill on it, and you don't gain that market share. With Meta, there's a dual-pronged approach. First, there's many people on Wall Street downgrading Meta stock because they say, quote, there's significant investment in superintelligence despite unknown revenue opportunity mirroring the 2021-2022 metaverse. Meta hasn't proven a lot with their superintelligence in the same way that Google has with DeepMind or their cloud hosting. Google has a very clear path to having high returns. But the thing that Wall Street is missing here is, even if this is the case, let's assume that Meta spends a bunch of money on superintelligence and it doesn't come to fruition. They don't get a high return on that superintelligence spend. Well, there's different use cases for this server capacity. There's different things that Meta can do to utilize this spend. Mark Zuckerberg notes that if this big bet in superintelligence spend does not pay off, they still have other use cases for all this aggressive Capex spend. He says, quote, that way, if superintelligence arrives sooner, we will be ideally positioned for a generational paradigm shift in many larger opportunities. If it takes longer, if this spend doesn't have a return on superintelligence, quote, then we'll use the extra compute to accelerate our core business, which continues to be able to profitably use much more compute than we've been able to throw at it. Mark Zuckerberg has done the risk-reward calculation for this spend. If he spends now, he has the opportunity to potentially get to superintelligence, which will be a huge paradigm shift. If that does not happen, then Mark Zuckerberg can reroute all that spend, all that Capex, all those GPUs on making their core services more profitable, more AI ads, more AI-generated slop for the now 3.54 billion daily active people using one of their apps. They have half the world using their applications. Mark Zuckerberg knows this, and he knows that any spend on compute will be used. The capacity is not going to go to waste. The stock now trading at a 21 forward PE ratio, a 2.7% free cash flow yield. With it having a one-time tax hit dragging down its profitability in the short term, Meta now has a good story over the next 5 years, one of being the framework for social media throughout the world. Now moving on, we get to two companies that I believe are very similar in their investment thesis. We have Salesforce and we have Adobe. Both of these companies trade at optically low valuations, meaning that if we just look at one of them, let's take Salesforce, and we look at some of the valuation metrics, they look pretty cheap. Salesforce trades at a 20 forward PE ratio, a 5% free cash flow yield. Even adjusting out the healthy level stock-based comp they have, it is a 3.79% free cash flow yield. That is similar to highly cyclical, slow-growing, heavy Capex businesses, ones like industrials. But in this case, Salesforce is a company with growing margins, growing revenue, and quickly growing earnings and free cash flow. Adobe looks even cheaper today. At a 14.5 PE ratio and a 6.9% free cash flow yield, even adjusting out the stock-based comp, we're at 5.5%. This is incredibly cheap by the numbers. You would assume companies trading at these valuation multiples would be companies that are dying or in decay. But to the contrary, both of these companies are growing. Salesforce is growing between 8 to 10%. This is well above the rate of inflation. Every segment of the business is growing. We have Adobe, which is growing a little faster. Revenue is growing 10 to 12% per year. You can see the long-term trend is in line since 2014. These are both business critical services. Companies sign long-term agreements with them, beyond 1-year contracts. With Salesforce, their contractual revenue growth grew by 12%. We look at Adobe and we see the total performance obligations, their contractual revenue growing likewise 12 to 13% year over year. Both of these companies are incredibly free cash flow positive. Salesforce now generates $12 to $13 billion in free cash flow. And you may say, well, Salesforce is a dilutive company. Look at all the stock-based comp. That view is a bit outdated. You could have said that they're a highly dilutive company back in 2022 when 50% of their free cash flow was stock-based comp. But now the stock-based comp has held steady for 3 years, while the free cash flow has gone up 2 to 3 times as much. Adobe likewise has rapidly growing free cash flows. It's gone through some time periods of investment, but now it's at all-time highs, $9.6 billion in free cash flow, a 12% increase over the past 2 years, a 14% CAGR over the past 5 years. Both companies are returning more capital back to the shareholder. Salesforce is doing it via dividend and through buyback. Adobe's ramping up their buybacks even faster. In the past 12 months, they bought back $11 billion worth of common stock. For Salesforce, the price to earnings ratio is at a low over the past 3 years. Both of these companies have gone down as the rest of the market has raced up. As investors, we don't know when the fundamentals will come into play, when investors will start to value these stocks once again, when the winds of sentiment will shift. But it will eventually happen if these companies continue to perform. They are so cheap now. They have such good economics. If these companies continue to grow over the next 5 years at even a moderate pace, they will have exceptional returns. Now, some of these companies I own, some I don't. In the passive income portfolio, I don't own Meta. I've chosen to go with Google. I don't own Adobe, but I've chosen to go with Salesforce. The next couple of companies that are undervalued today and worthy of new buys are in the finance category. We have Equifax and S&P Global. You could also include FICO or Moody's in this group of companies. I believe this entire category is undervalued. If we look at the performance of these stocks, I have many of them in my portfolio, but all the ones that are in the green are the ones that I've owned for well over a year. For example, S&P Global is up 28,000, MasterCard 34,000, Intuit 21,000, and Moody's 10,000. These are good gains, but almost all of these gains came before 2025. In fact, if I filter this by the year to date, you can see how these performed. S&P Global's flat. MasterCard's up 5.7%, underperforming the S&P 500. Intuit's up 5.4%, underperforming the S&P 500. Moody's is up 3.3%, and Equifax is the worst performer, down 15%. This entire category has underperformed the S&P 500 in 2025. That's actually not a reason to be concerned. In some cases, the market focuses on different trends and momentum pushing the indice higher. And in this case, there's no focus on these high-quality finance companies. The major focus has been on AI companies. But if we look at what's going on under the hood of companies like S&P Global and Equifax, it paints a much better picture. S&P Global is a company that's grown its revenue at moderate rates above expectations. They grew their net income above expectations, and they even raised their guidance above what the guidance was expected. They grew their free cash flow above expectations, and they've raised guidance on their free cash flow as well. The company is still a powerhouse, diversified, wide moat company with ever-growing earnings per share. Everything seems like business as usual for S&P Global. If we look at Equifax, it's a different business but operating in a similar industry. The share price of Equifax falling 17% year to date may leave you with the impression that the business is fumbling, things are struggling, the company's having its moat eroded. That doesn't reflect the situation going on with this company at all. Equifax isn't only just performing to expectations, they're beating expectations. They're raising their guidance. Every single quarter, they continue to say, hey, investors, we're going to earn even more money than you expected us to earn. While the market continues to discount these companies, saying that they're not great investments today, investors shouldn't be focused on them, I believe there's reasons why investors should be focused on Equifax, S&P Global, or Moody's or FICO. You could throw all of them in the mix. This is a category that should see massive tailwinds over the next couple of years. One of them is interest rates being lowered. These companies benefit in diverse ways from interest rates being lowered. There's higher debt issuance, which benefits S&P Global and Moody's. More people take out loans, which benefits companies like Equifax. More people take out mortgages, which benefits FICO, and again, Equifax. There's also just more economic activity and more interest in investment, which benefits S&P Global's data, market, and indices business. Lower interest rates benefit these companies immensely, and interest rates will continue to go lower. President Trump even said that the new Fed chair that he's putting in, the major reason he's kicking out Jay Powell and putting in a new one is to lower interest rates. Another thing that will benefit these businesses is artificial intelligence. They'll be able to do more with fewer employees. As AI picks up steam and these tools get implemented across these companies, they will be able to offer more tools, more products for their customers at reduced costs. So you'll see margins and operating leverage continue to pick up. So even though the market has ignored companies like S&P Global, Moody's, or Equifax this year, they've been underperforming so far, their fundamentals show no underperformance. They are growing faster than expected, raising guidance, and they have many catalysts for the future. I believe they're all buys today. Now finally, in number 6, the last stock that I'll highlight that I believe is a buy today is in the Story Fund. In this portfolio, I have a more concentrated look on a few companies, and one of them that has been an incredible winner in this portfolio, of course, is Netflix. It was as high as $1,300 per share, and now it's below $1,100 per share. While some investors will interpret this as an overpriced company coming back down to a more realistic valuation, I see it differently. I think that this is an opportunity for investors that have missed out on Netflix to finally take a bite. And the reason why is because I believe that Netflix is not overvalued. I've studied this company for a long period of time, and I still believe there's far more to come that's not being priced in for Netflix. For example, we have the immediate catalysts. We have the things that Wall Street knows about that investors are expecting, like the Stranger Things finale. This is going to be what people talk about the end of this year. This is going to be a massive shared TV experience across the entire internet. There's not many things that unite hundreds of millions of people across the world under a single event. The other most recent thing that's caused hundreds of millions of people to unite under a single event is likely the K-pop Demon Hunter movie. These are all owned by Netflix. The big shared experiences across the globe are now being owned by Netflix. But more importantly than just a few pieces of content uniting the world, we also have the sheer financial strengths of this company. It is a cash flow juggernaut with ever-growing margins and fast-growing revenue, with a huge total addressable market and a long, continued growing runway for growth. If we look at Netflix, there's just a couple things that I want to highlight. First of all, we have the revenue growth of the company growing at 15%. This is in the upper, higher tier of companies. A lot of companies, again, are struggling to grow maybe 8 to 12%. Netflix has cracked the code on pricing, on tiers, on getting a lot of people to sign up for their company. They have a cheaper priced ad tier. They have different premium priced subscription tiers. They have a plan for basically anyone. You can even add on friends for $3 a month. So Netflix makes its service incredibly affordable to the broader public. And the value proposition that they offer is immense. With all the content they offer, all the movies, all the documentaries, all the live events, all the sporting events, it's very difficult to not have a Netflix subscription. So Netflix is now transitioning to this company where it will have sustained revenue growth. The revenue should continue to grow between 14 to 16% throughout 2026, another entire year of the same speed of revenue growth. That is my estimate for this company. And then after 2026, I could see it slowing down incrementally from there. But the deceleration will be slow. Netflix has a very long runway of ample revenue growth. One of the benefits that Netflix has is incredible levels of operating leverage. Despite many people's beliefs, and many people have gotten this wrong over time, Netflix does not need to raise their content spend or the amount that they're spending on producing all of their shows at the same rate that they raise their revenue. They do not need to do that. And you see that in the numbers over the past 5 years. From 2019 to current day, Netflix only increased their spend on content by a marginal amount. Meanwhile, revenue has over doubled. So this is a company exercising incredible levels of operating leverage. And again, many investors have gotten this wrong. Aswath Damodaran was one of the most notable, saying that Netflix's big spending business model can't last. He says they're on a mouse wheel of content spend and it was not sustainable. These were the views shared in 2018. but Netflix showed that that's not the case. With revenue continuing to grow at 15% and content spend growing at only 7%, the operating margins of the company continue to tick up every single day. In fact, Netflix's operating margins are so high now, it's in the higher premium category of highly efficient companies. Without the one-time tax hit from Brazil, the operating margins were closer to 29%, above expectations once again. They're guiding for future growth in operating margins. My estimate is that they will continue to keep their content spend tight. It'll come in under analysts' expectations. The operating margins will continue to tick up above analysts' expectations. In fact, I believe by 2031, so around 5 years from now, this will be about double. We'll see operating margins of around 50%. That seems crazy now, Netflix with 50% operating margins, but they have a clear path to get there. They have incredible levels of operating leverage. Companies that create content scale incredibly well. If you have a company that has that level of operating leverage, you're also going to see exponential earnings per share growth. The earnings per share grew by 35% year over year, and that's with this last quarter having a one-time substantial tax hit. It'd be even faster without that. I expect the earnings per share growth to grow above 25% over the next 3 years. Netflix will be one of the fastest EPS growing companies in the market. Then we get to how all of this translates to pure free cash flow, the best estimate of how much money a company's actually making. Netflix is one of the least dilutive free cash flow companies you could buy, with only a tiny amount, $300 million of stock-based comp, compared to $9 billion of free cash flow. And Netflix is growing its free cash flow at an incredibly fast pace, 26% year over year. In 2025, they're guiding for $9 billion in free cash flow, a notable step up of $7 billion just a year ago, but it doesn't end there. By the end of 2026, I believe that Netflix will have around $14 billion in free cash flow generated, based on the operating leverage, based on the growth of this company. So we're going to go from 7 to 9, all the way up to around 14. This company's free cash flow will continue to spike. And on top of that, it's not just free cash flow, it's also free cash flow per share that's growing even faster. Netflix is now a company that's in a place to do a massive amount of share repurchases. This is an incredible, fortunate situation to be in. Netflix is a stock that I believe is less obvious than the others because it's still priced as a premium company, but I believe it will have above premium performance. This company will continue to surprise. It'll continue to adapt and grow. And the financials should support massive share price increases over the next 5 years. For me, it's worth buying. Now, of course, there's no guarantees that all these stocks will go up and to the right. That never is the case with investing. But I believe investors will do very well with any of those stocks over the next 5 years. Now, moving on, we get into some news of some other companies that have reported earnings, Uber being one of them. The stock is down a little bit, but overall, it's been a fantastic year for Uber investors. The stock is up dramatically on the year to date. And here is Dara, the Uber CEO, sharing his view this quarter.
Well, I think what drove it is strength across all sectors. Our mobility business accelerated versus last quarter in terms of top line growth. Our delivery business accelerated as well. Trips, 3.5 billion trips this quarter, up 22%, big acceleration versus the last quarter. Gross bookings now just south of 50 billion quarter and up 21%. And then, of course, delivering on profitability as well. Our EBITDA up 33% on a year-on-year basis. So we're seeing a business that continues to be strong. It's actually accelerating in terms of momentum, and we're able to scale profits while we do so. So, Andrew, at this point, we see blue skies. Obviously, we are watching out in terms of the economies, the global economies. But at this point, the business continues to hit on all cylinders.
He has a great summary, and I agree with everything he said. Looking at Uber, it had another great quarter, even though the stock is being a little bit squabbly today. I love it when the executive is focused on the big picture while being realistic.
We're very lucky to be operating in the transportation services ecosystem that is over $1 trillion, the online food delivery or food ecosystem that's over $2 trillion. And now we're extending into grocery and retail. We were at a $12 billion run rate as it relates to grocery and retail. And what we're seeing is people want on-demand transportation regardless of where they want. They want to push a button and get to a place. But sometimes when they want to stay home, they want to be able to push a button and get their groceries and have someone else maybe do their Thanksgiving shopping for them. So I do think it's a combination of both. We are unique and different from all the other players in that not only are we global in scope, but we also operate a mobility marketplace and a delivery marketplace that talk to each other. We share customers, we share merchants, for example, on the ad front. It's a platform that no one else can match. And as a result, while the category is super healthy, we're also generally gaining category position and growing faster than the overall category.
Now, he highlights Uber's relative growth, which is important to note that they're taking market share, and the category that they're taking market share in is also a growing category. This has been the theme of many successful investments. You don't just want a company that's winning, but you want a company that's winning in a growing area. And what he said about people just wanting to press a button, I think is the best explanation of why companies like Uber or DoorDash or Amazon or Netflix or Spotify are so successful. People want things that make life easier. They want to make life much easier for them. This is where technology and scaled technology makes life easier. It resembles in very similar fashion how Amazon was so successful. They took a difficult, complicated process of online shopping 15 to 20 years ago, and they simplified it dramatically. They made products easy to buy and eventually made it so you could simply buy a product with a single click. And then in 2 days, it would show up on your doorstep. People love convenience, they love simplicity, and Uber offers that at scale. It's going to continue to grow in this category. Now, moving on, we have news that one of my largest positions, which is Amazon. I believe Amazon, and I've mentioned it so many times, that I think it's one of the best companies in the market to own today. I just think it should be in everyone's portfolio right now. We have news here. Here's the title of the article. Amazon sues to stop Perplexity from using AI tool to buy stuff. Amazon filed a lawsuit Tuesday demanding Perplexity stop allowing its AI browser agent, Comment, to make purchases online for users. The e-commerce giant is accusing Perplexity of committing computer fraud by failing to disclose when Comment is shopping on a real person's behalf, in violation of Amazon's terms of service. Amazon is introducing a dispute after sending a cease and desist letter to the startup Friday, accusing the smaller company of degrading the Amazon shopping experience and introducing privacy vulnerabilities. So basically what's going on here is Perplexity, similar to OpenAI, announced a new browser. OpenAI's browser is called Atlas, Perplexity's called Comet, and they're both would-be competitors to Chrome. But with Perplexity's browser, it has an AI shopping tool where it will help you scrape information and buy different things on Amazon, bypassing Amazon's user interface and making it all go through Perplexity's AI agents. Amazon claims that Perplexity's browser pretends that it's simply a user through Chrome accessing the website, when in reality it's an AI agent that behaves and acts in non-human ways. And this is in direct violation of Amazon's agreed upon terms of service for each user. Now, Perplexity responded by trying to portray and frame Amazon as a bully that's against innovation. Perplexity wrote a blog post saying how innovation comes when people make new products, and bigger companies always try to stop innovation by bullying these smaller corporations. They're framing it as user choice, that users should be able to access Amazon in any way that they want, and that users love the Comet user experience. They claim that their AI browser is private, personal, and powerful, and that they're not going to be intimidated by the big bad bully, which is Amazon. Now, Amazon responded to Perplexity's blog post portraying them as a bully. Amazon says, quote, "We think it's fairly straightforward that third-party applications that offer to make purchases on behalf of customers from other businesses should operate openly and respect service providers' decisions whether or not to participate. This helps ensure a positive customer experience, and it's how others operate, including food delivery apps and the restaurants they take orders from, delivery service apps and the stores they shop from, and online travel agencies and the airlines they book tickets with and for customers. Agentic third-party applications such as Perplexity's Comment have the same obligations, and we've repeatedly requested that Perplexity remove Amazon from the Comment experience." So there's the breakdown between the two sides, and this argument has huge implications. It could determine the future of AI or agentic shopping. For example, Perplexity is saying that Amazon cannot control their user experience. We can control that. We can create applications that log in on behalf of the user that completely change the interface to whatever way we want, that can scan thousands of listings, do agentic searches, scrape the website, transform the data, manipulate the data, and scan and use your product and service in any way that we want. Amazon's saying that although you want to do that, you don't have the right to do that. A lot of this lawsuit comes down to things of whether or not terms of service really matter, whether they should be respected. A terms of service is a contract between the customer and the user of that service. Now, most people don't really look at it, but there are some legal protections that make sense for services. For example, a boilerplate terms of service for most applications and websites is you can't scrape the website. You simply can't create a bot that logs into a service like Bloomberg and scrape every single article every day and then export all that data somewhere else. That's not how it's intended to be used. That's not how Bloomberg or the Wall Street Journal wants you to use their application. They don't want you to create an application that scrapes all the data and exports it somewhere. So they write that into the terms of service. Now, from their perspective, that seems reasonable. They're not selling a product that you can come in and copy everything from the product. That's very similar to saying that you can't go into a movie theater with a camera recorder and record the entire movie. That's not the way that movie theaters are intending to share their product. They want you to experience it in a normal human behavior, not in these other ways that violate their intended use. Imagine if food delivery companies like a DoorDash and Uber Eats said, hey, restaurants, you have to partner with us. You don't get a choice or how your restaurant operates or what type of apps you want to integrate with, which ones you don't want to integrate with. From now on, every single restaurant has to use Uber Eats or DoorDash because that's the way the customer wants to use it. Many restaurants don't partner with DoorDash. They don't partner with Uber Eats because they don't want to have their margins hit. It's not an intended use of business that they want to cooperate with. And some of them do. That is the choice of the business owner with restaurants. And like Amazon points out here, I believe that's a strikingly similar example. If we were to say every company has to use agentic technology, it's very similar to saying every company has to use food delivery apps. Every travel agency and airlines, they now have to operate with Booking Holdings and with Airbnb. They have no choice in the matter. They have to operate with these new technologies. And while Perplexity likes to act like it's on the moral high ground, being an innovative company and a smaller one that's being bullied by a big bad company, that couldn't be further from the truth. Perplexity is simply being asked to operate like any other business and respecting the simple and reasonable terms of service of a company. Now, again, you may not say that terms of service are meaningful, but even Perplexity themselves believes that terms of service are meaningful, enough to highlight them front and center on their legal hub. And they have extensive terms of service for the intended use of their own application. And amongst Perplexity's own terms of service, they say that you may not do any of the following things in connection of your use of the services. Right on their own services, they say that you cannot use automated software, bots, hacks, or modifications, or any other unauthorized third-party software designed to modify the services. In Perplexity's own products, they ban people from using automated software and bots, or otherwise known as AI agents. You cannot exploit the service for commercial purposes, which is exactly what Perplexity is doing. They want to bypass Amazon's use case, making it so that Amazon cannot serve advertising, and users pay Perplexity and use their comment browser, paying a fee every single month at the detriment of Amazon. This is precisely what Perplexity blocks in their own terms of service. Perplexity is very careful to outline the same thing over and over again, that you cannot use anything like a bot, a spider, a crawler, or a scraper, or other automated devices to process their software or their queries. If it is true that scraping websites, changing the user behavior, using bots and AI automation tools to log in and use your product however you want, if that's such a good thing, Perplexity, then why are you banning it through your own terms of service? Why is your legal team, exactly like Amazon, highlighting that that's not how you want your technology to be used? Is it because it might break your business model? It may break your product. It may not be the way that you want your services to be used. It's not the way that you built them and designed them. Could that be the case, Perplexity? If Amazon is a bully for enforcing their terms of service, then Perplexity is a hypocrite for enforcing the exact same terms of service upon their users. That's going to be it for this episode. Hope you enjoyed, and see you in the next one.